Well, hello, welcome to the show. It's Les Solgrove, Simply Des Moines, and we're just finished up week 7 of 2023. 7 weeks in the books. It doesn't seem possible. In fact, next week is the last week of February, the last full week, I should say, of February. And so we'll see kind of how the market goes there. We've had some weather events this past week that's kind of affected the market, but in the meantime, let's just kind of jump right in here and look at the hot sheet. I've got a couple things I want to point out on the hot sheet this week. Again, because of the weather we had this past week, where we had a couple days, we kind of slowed down just a little bit. Our pending sales dropped just a little bit. We're about 30% behind. But the good news is, I believe this is going to be the week that we finally hit our first 1,000 milestone of year-to-date closed sales. And you can see a year ago at the same time we were almost 1,500 closed sales. So we are a good 500 closed sales behind as far as days on the market or days into the year so far. So we're seeing still a little bit of growth in homes for sale, although that number again is also dropping, as we'll talk about this week. So this graphic is available, like I say, every week. It's available at DesMoinesMarketValues.com. It's on the homepage. It's updated near the end of every day, and it stays there until the end of the very next day. So at the very least, it's just yesterday's hot sheet until I update everything manually and bring it up to date for the next day there. So please utilize this. It's a good resource to have at your fingertips. So this week we're going to talk about two topics. We're going to talk about mortgage interest rates and the real estate cycle. Spend most of our time on the cycle, but what I wanted to do is give you a little background as to where I'm finding these mortgage interest rates, because I get comments most of the time when I'm talking about the national average mortgage interest rate, and I'll say it's at like 6.5% or whatever it is that time, and the local rate is usually better than that. Well, this is the national average. It's put together by Freddie Mac, and it is called the Primary Mortgage Market Survey. And it is available if you want to do some research on your own. Right here's the URL. It's at ycharts.com. I think if you just go there, you should be able to navigate and find the 30-year mortgage interest rate. There's all kinds of cool stuff on that website. It does have a paywall, but for the most part, everything I pull from it is basically free. And I do like this because it goes all the way back to 1971 is the how far back they've gone since they've been collecting this data. And the long-term average, as you see right here, the long-term average is 7.75%. So if you look over the last 50 plus years, 7.75% was the long-term average. Now, obviously, we're below that, which is good. So, how I utilize this. In fact, here's that chart going all the way back to 1971. I utilize that to kind of chunk things out into decades. So that's what I've got here. I've updated this graphic from last year, and you can see that I've got the 70s over here, the 80s, 90s, 2000s, all the way up to the current decade of the 20s. And what I did was the little dotted line here indicates the decade. And you can see here in the 70s and the 80s, the average rate in the 70s was 8.62%. And of course, the 80s, no surprise there. That was the year that the farm crisis and all this other stuff we had going on in the country. 12.66% was the average rate for that decade. Going through the 90s, 8.07%. The 2000s, we got into the new millennium, and we got 4.2 for the first 10 years, 4.02 for the second 10 years. And for this third decade, starting into the 20s, it's going to be kind of interesting because we were really pretty low as we started out this decade. But up until last year, we saw that huge rise. So as a result, still much of the data is heavy on the lower rates. So the average rate for so far in the 20s from 2020 to date is only 4.12%. Now, obviously, that's going to continue to rise as unless rates drop down dramatically again. But we're probably going to see our rates, I keep saying, somewhere around that 5 to 5.5% is where it's going to settle in before year's end. But anyway, so this is the 1971 to present graphic. I kind of like that because it gives a good perspective, and you can share this out with whoever you like. There, it's just a good graphic for that. If we look at just 2023 compared to last year, now I like this one too because this black line indicates the rise of mortgage rates last year and how fast they rose from just over 3% national average all the way up to just over 7% nationally. This gives you some indication of where we are this year. And since we're only about 7 weeks in, this line is pretty short. But you can see that we started out until last week, we were actually on a downhill trend, and it kind of ticked up this past week. Actually, it ticked up just a little bit the week before, but nothing major. But this past week, it ticked up quite a bit. And, I've had these graphics in the past, and I'll go ahead and go to this next slide here. This slide shows you the week by week mortgage interest rate from this mortgage interest rate survey from Freddie Mac. And 2 weeks ago, we were at our year-to-date low of 6.09%, and things were looking good, like maybe we were going to get down into the fives soon. And then 2 weeks ago, it ticked up just slightly, and then this past week went back up to 6.32. It's still not as high as our January year-to-date high that we had just under 6.5% in January. What this does reflect, though, however, is the purchase power. And again, just using an example of a $1,200 a month principal and interest only payment on a 30-year fixed rate mortgage, that $1,200 calculates based on the existing national average mortgage rate that this past week the buying power would have dropped down to $193,462. If you recall, back last year, we were down in the 180s, $170,000 price point when interest rates were extremely high, closer to that 7%. So we're nowhere near that level. Obviously, we want to be able to have lower interest rates, which in turn turns the buying power into a higher number. It'd be nice to get back up above $200,000 again. And that would only take us to get down to rates. Let's go back here. Would only take us to get around that 6% is all it would take for us to get close to that $200,000 price point. All right, so the meat of the show this week, it's the real estate cycle. I have talked about this several times over the last year or two, but I really want to go out on a limb tonight, and we're recording this on Sunday night, so tonight we're going to go out on a limb and try to predict exactly where we are in this real estate cycle. And just for your reference, there's basically 4 cycles to a real estate cycle, 4 phases. We have the expansion phase. That's where inventory levels on the rise, buyer demand's high, prices are rising, days on market is dropping. That's just a very, very busy, fast period of time. And I've got some indicators on the next couple of slides that'll give you an idea of tied to times of the year that the last couple of years that we have been in, that will give you an idea that we actually came through that expansion period. The second phase of the cycle is the peak, where we basically we're not going up anymore. It's kind of leveling off. Buyer demand is still high. Home prices are still high, and time on the market is still very, very short, but we're just not seeing the continued high growth of inventory or buyer activity, I should say, at that point. So the peak is kind of where we have been. And then the third phase and fourth phase is the slowdown and recovery. Now, there's no rhyme or reason to how long each of these phases last. The typical real estate cycle in a typical market is about 10 years. And you will see the expansion period go sometimes very, very quickly. Sometimes that'll take 2 or 3 years. Sometimes the peak will stay up there for a year or two. The slowdown can be very slow, or what I think has happened in our current market, the slowdown has happened quickly and could bring us back into recovery. It doesn't mean we are always going to be in a 10-year cycle. That's the typical cycle. In fact, let's go to the next slide here. And this will show you the last cycle we had on the left side, on the left of the dotted line right here. You'll see that the last cycle we had was a 10-year cycle from about 2000 up to 2010. It just so happened it was started in about 2000 and ended at the end of a decade. The mortgage meltdown happened in there, the peak of the market with all the crazy loans and things like that were going on. The market peaked, slowed down, and went into recovery. That was about a typical looking real estate cycle. It was 10 years. It had a fairly even phase on each of the four phases. And then we look at our current phase, or our current market that we're in, which is about 12 years and counting. And this is the graphic that I've shown you before, where I said we were about 2015, at about 2019, it looked like we were going to peak, and then up to 2020. And where are we at right now? Well, what I did was I reworked this side of the graphic. So let's go to that one. And over here on the left-hand side, here's our four phases: expansion, peak, slowdown, and recovery. And there's where we started off in 2010 with our starting our expansion period. And expansion went through 2015, past 2015, and all indicators were that in 2019 we were looking like we had peaked, and our market in 2020 was going to turn into a slowdown market, albeit still more than 10 years, but it was certainly looking like a very typical market. And we all know what happened in 2019, 2020. We had COVID-19 come into play. And that totally upset the real estate market cycle here. What that did was, instead of peaking and starting the downturn here, the slowdown, we actually had a second expansion period without going through the slowdown and recovery. And that was when obviously the market was just as crazy as we've seen it. Multiple offers over list price, buyers foregoing inspections and paying, not asking for repairs, those kind of things. That was a really, really crazy time in the real estate business. And I would say that just everything I'm seeing in the marketplace, it looks like we have peaked in 2022. The market started to slow down. Some of that, or much of that, was probably due to the rise of home mortgage interest rates, which disrupted the buyer pool quite a bit. And so then the question comes is, where are we in this phase here? Are we in the slowdown? Are we in the recovery? Are we beyond that? Are we still at the peak? And so what I wanted to do was basically overlay the peak area here. And these are the attributes, or the indicators of a peak market, where the inventory level was leveling off, which we saw that. In fact, we saw our inventory levels was really odd, because normally you would see inventory rise through these expansion periods, but we saw just the opposite of that. But in reality, still our inventory level kind of leveled off in 2022. Buyer demand was at the highest, and we did kind of hit our maximum home prices in the marketplace, and time on the market was extremely short. So that all points that 2022 was probably a good indicator that we had hit the peak market. So the question is what's happening in 2023, or what will happen in 2023? Are we going to be in the slowdown market? Is inventory decreasing, price reductions happening, those kind of things? Or have we already hit that, and are we currently in recovery? And so let's just focus on slowdown and recovery here on this next slide. And what I did was I took the attributes of slowdown and the slowdown market and the recovery market, and basically looked at the information that I've collected and try to analyze whether or not we are either in it or have been through the slowdown market. Now, one of the attributes of a slowdown market is that inventory does decrease. And you can see that just in 2023, so we're looking at 2023, are we in a slowdown and recovery? Some of this is just the natural cycle of the year, but we do typically, we do see inventory year to date decreasing as the year has gone on. We had just a little bump right here this past week of homes for sale. But it also matches that low home inventory attribute also on the recovery. This is the lowest we've basically been in 2023. And by looking at all indicators, it looks like moving forward, we should start, if we follow this line, and I apologize, the graphic covers up the rest of 2022, but that it just goes up and then kind of back down again. It looks like we should start to rise, our inventory should start to rise as we move into 2023, into the spring market here. So I gave both of these attributes a check mark. I also gave the slowdown check mark to buyer home selection advantage. Now, true, we are still in a seller's market overall, but new construction is definitely a buyer's market. and the existing home sales, while it's still in a very, very competitive seller's market, the number of buyers out there right now are fewer, and we're not seeing that competition for multiple offers as much. That doesn't mean we're not seeing multiple offers. We're just not seeing as many multiple offers. And in addition, we're probably not seeing as many offers above list price. They're probably offering at list price. And, buyers are still going through the process now of doing home inspections, which is good. And obviously they're all pre-approved. Most buyers today are not looking unless they're pre-approved. But this basically gives me 2 check marks on the slowdown market that says, or slowdown attributes saying that we are in a slowdown market. So if we go to the next graphic, we're going to look at buyer demand. And buyer demand is kind of measured in the method of looking at the 30-day sales pace. So what this graphic shows you is offers accepted within the past 30 days in a rolling 30-day period. So back in January, the week 1, it would have said from January 1st through the first week of January back to the first week of December. So looking back 30 days back, this is the average number of homes of offers accepted. So about 600 and 650 maybe homes accepted. And you can see that we were on a stair step of increases all the way through week 6 until this past week. Now, what happened this past week? We had a little weather event. That Thursday snowstorm came and it kind of slowed everything down. I think maybe that might be the reason why we've seen this market slow down just a little bit. But regardless, we're still well below the 2022 sales pace, which then goes ahead and gives me the confidence of saying, we are still at the buyer demand is still at the lowest, which is an attribute of a recovery market. The third attribute we're going to look at here is price reductions. And again, I've kind of got the graphic covered here, but you can see that from January, every week so far in January and into February, we are still adding more price reduced properties. We're making more price reductions on our existing properties. In fact, week 2, we almost had 100% increase over the previous year, almost 175, and here we were at 75 the year before. So that's another attribute that says, hey, we've gone through, or we're at least heavily into the slowdown market, because price reductions are very common. In fact, last year it was very, very common. We were seeing price reductions from about May or June on. What about home prices being most affordable? Well, the graphic we're going to look at for that to see if we're in recovery is the median list price, not the sale price, not the pending price. This is the list of prices of homes that are currently on the market that the buyer pool has to select from. And you can see that we are still still above 2022's median list price so far into the year, 7 weeks in. I put a question mark on this because I think the mortgage interest rates are probably skewing this more, and the lack of lower existing home inventory is probably skewing this off a little bit, and we're seeing a little bit of the new construction and pricing kind of coming in and raising that price. But I just can't specifically say right now that home prices are the most affordable, because this pricing is still above last year's. If we start to see this number trend below 2022 as we move forward, then we'd be able to give that a solid check mark. So that one's questionable. Let's look at time on the market, or the days on market. This is the weekly look at days on market. And whoops, sorry about that. What I am seeing on this is we have a dramatic rise in the days on market. In other words, it's taking much longer for homes to go under contract and sell than it has at any point in time in the last couple of years. And so you can see right here that, it started off the first of the year, we were at about 18 days on the market, and we're almost up to 30 days. We're at 29, 28 days on market on average right now. So time on market is definitely increasing, and this is hard for some home sellers to accept. I mean, they're used to seeing their homes go under contract instantly, and those still happen if the property is in very, very good condition. Are priced right or whatever. But this time on the market is increasing overall. And that's true for both the slowdown, and we are currently at the highest point this year of time on the market overall. So the trend for increasing is true for the slowdown, and for the recovery, we are at our peak. So that does give me 2 check boxes there. So if we look at both of these, we'll go ahead to one more graphic here. And there we are. We look at this here. There's our slowdown over here to the right. All 4 boxes are checked. We've got home inventory decreasing, buyer home selection. The buyers are having more opportunity to find their home, even though there's fewer homes out there. They're able to take their time. Price reductions are common, and time on the market is increasing. If we look over here to the recovery side, again, there's our 3 check marks and the question mark. Home prices most affordable. So before I really commit that we're in recovery mode, I really wanted to think about home pricing and whether home prices are most affordable. And I'm going to check one more box up here on the expansion side. We are starting to see home prices on the rise. We've seen that. If we continue to see home prices on the rise, remember I said if this goes down below 2022, then we'll check this box. But I think what we're going to see moving into 2023 is home prices at least maintaining, if not going up just a little bit over 2022. And so it very well could be that the recovery period will never see this checkbox. So what we want to watch here in the next few weeks is if we see more signs of the expansion coming on board. For example, if we start to see a large increase in home inventory levels, if we start to see buyer demand come on more, and we start to see perhaps rates go down, and we start to see again multiple offers and days on market dropping down, then I would be very comfortable at that point saying, hey, we are back in an expansion mode. But I think for right now, I'm going to go ahead and call it today, Sunday, the 19th of February. I'm going to call it that we are in recovery mode. I believe that's a safe call. I don't think we're going to stay in the recovery mode long. I'm going to kind of guess that as the spring market comes on, the weather breaks, we're going to jump right back into an expansion. It's going to be a slow expansion for 2023. And it might take all year for us to actually be able to check all 4 of these boxes. But I do believe that we're going to have our recovery. Our recovery is going to be past us, and we will be in an expanding mode, a very, very slow expanding mode as we move into 2024, and watch for 2024 to be the more typical year in real estate. So anyway, that's the show. I'm curious what your thoughts are. Please leave your comments and questions in the show notes below. Also, be sure and hit that thumbs up on the YouTube video so that I know that you are getting value out of this product, and also hit that subscribe bell, because then you'll know on Sunday nights when I produce these, you'll get a notification that there's a new show out there. You can watch them first. So with that, thanks for joining me. My name's Les Sulgrove. This is Simply Des Moines Market Update, and don't forget, go to DesMoinesMarketValues.com for all of the graphics. Talk to you again next week.